Hi, Richard Hemming here from Under the Radar Report. I'm here with, as you can see, Roger Montgomery, whose name is actually synonymous with stock market investing per se, but today's focus is small caps. Hi, Roger.
Good to be with you, Richard. Nice to see you again.
Well, it's great to see you again. It's been something like 10 years, or maybe longer.
Except for the wedding recently.
Basically, one of the reasons we're talking small caps is I looked across your portfolios and the outstanding performance was in small caps. Can we get a bit behind that performance and your small cap kind of offer, and obviously whether that performance is going to continue?
So the Montgomery Small Companies Fund is actually a joint venture between us and Gary Rollo and Dominic, who are the portfolio managers and analysts for that fund. Their performance has been extremely good recently, and I think that's partly because of positioning for what we believe are the characteristics of the market right now, which are supportive for small caps in particular, and I'll just go through that.
Sure.
So if we go back to November 22, which is, now we're recording this in early 24, but back in November 22, we just had the market plummet. You might remember that.
Everyone remembers that.
It was extremely...
Except for my kids.
We just had a rapid, historically rapid rate rise, or a series of rapid rate rises. And then there was a fear of recession as well. The combination of high rates and recession really saw the stock market plunge. We had the view that there wouldn't be a recession. And we also had the view that the rate rises would have a positive impact on inflation. In other words, inflation would start to come down. Now, if you go to
the Goldilocks scenario was in your.
Yeah, we don't use that term, but what we do know is that way back in the 1970s, in late 1978, Gabacle Research, which is still an economic research firm that are around, they published and presented a matrix in 1978, and that was given to me by another fund manager, a guy named David Paradise. He gave that to me in the early 2000s, and I've hung on to it ever since, and it's been incredibly useful. What it said was that the combination, there was a matrix, and basically on the horizontal axis was economic growth. Everything on the right-hand side of zero was positive, obviously. Everything on the left was negative. The vertical line, the vertical axis, was inflation, with everything above zero being accelerating inflation, everything below zero being disinflation. Whenever you have disinflation and positive economic growth, in other words, consecutive rates of lower inflation and positive economic growth, that's always been positive since the 1970s for innovative companies with pricing power and growth.
Right.
So that's what I believed we would have in 2023. Right. And we would have no recession, we'd have positive economic growth, and we would have disinflation. Inflation would start to come down.
Yep.
And that's precisely what happened. But the innovative growth stocks that took off were all concentrated in 7 mega cap companies, right? The Magnificent Seven. And that was because the fear of recession was real, and so there was
sort of a flight to quality.
Yeah, there was that flight to big cap safety and quality. So the AI theme was there to sort of help things along as well. But really, it was that innovative growth stock backdrop or innovative pricing power backdrop of disinflation, positive economic growth that drove those. What ended up happening was, that was 2023. And what ended up happening is the gap between large caps and small caps grew enormously. The spread widened. And in fact, we now have the largest spread between large cap performance and small cap performance since the GFC. So that to me is the setup for part of the setup for 2024, that you've got this massive underperformance, which should close because we've still got disinflation, we still have positive economic growth. So the backdrop is still really positive. But now I think there are 3 more reasons why we're going to see small caps do well. Number one is we've gone from a rate rising environment to a peak in rates, and probably a decline. I mean, the Federal Reserve Bank of New York is telling us we're going to get some cuts, and that might happen. So that's a positive shift. We've also gone from a fear of recession to a narrative of a soft landing. That's also positive for equities, particularly small caps. And then those two things combined led to concern about the volatility of earnings and potential risk to earnings. And what we've just seen in reporting season, both in the United States and also here in Australia, is that earnings have proven really resilient. And so when you look at those 3 or 4, 5 things, actually, disinflation, positive economic growth, we're moving to a soft landing rather than recession and so on. When we move to that environment, I can see that gap between small caps and large caps closing in favour of small caps. Doesn't mean that the large caps sell off. It just means I think the small caps outperform. And I put my money where my mouth is. I'm invested in small caps. I'm overweight smalls. I've invested more money in our funds. And also the Poland's global SMID fund, because I believe that smalls will do well. Time will tell, and I believe that over the course of this year, next year, and early 2026, so 2024, calendar 24, and calendar 2025, I think they'll be good years for equities and particularly for small caps. And I say that because I think going from a risk-off scenario to a risk-on scenario takes a couple of years to build. And it takes time to build because people are resistant and reluctant and they need convincing before they start taking risk again and buying small caps. So it will take a year or two, and then we'll see that small caps have done pretty well. That's my view.
Well, you said a lot. There's a lot to unpack there. But, one of the things you first said was how, is it Gary Rollo? Gary Rollo and Dominic Rose have a well-positioned portfolio. So can you go through the kind of positioning of that portfolio?
We'll talk about thematics first.
Great.
So they're definitely overweight growth at the moment. They're looking for growers. And I've got, and you may want to use this graphic potentially, but they're underweight materials at the moment. So underweight materials, underweight cyclicals, and overweight information tech. And we'll talk more about the stocks in just a moment.
Okay.
And consumer discretionary as well. Consumer discretionary. Previously underweight, consumer discretionary, overweight. Yeah, but that's the tactical aspect of the portfolio. So they're taking advantage of that change to those consumer discretionary stocks. So if I was to summarise the portfolio, I would say underweight materials, overweight growth, particularly tactical growth in consumer discretionary, and then what we would call structural growth. There's really a terrific tailwind for a lot of tech stocks in Australia at the moment.
And I guess in terms of technology stocks, there's a lot more press that, you talked around about the Magnificent Seven, but there's not that much focus on tech stocks in Australia. Did you want to talk a bit more about that?
I'd love to. We've got some great stories in Australia, particularly in data centres, the hardware around data centres, for example, Megaport, and then Audinate as well, which is growing its global footprint massively. It's sometimes, I think some investors would be in disbelief if they knew how dominant some of our Australian small caps are on the global stage. So if we start with Macquarie Technology, for example, which is a data centre, you know the business well. I think you've written about it recently.
Oh yeah, we're shareholders, and it's one of those sort of tech stories that's been emerging, and it's kind of really hit people in the face because it hasn't been acknowledged that much, I guess.
We see it as a stable compounder, which is not something you normally hear associated with small caps.
It's sort of more an infrastructure company almost than a technology company.
Well, I actually think they're both because
they are both.
They benefit. They're going to benefit from that AI, the growth of AI. And let me talk a little bit about where I think their growth, is going to come from. So obviously the expansion of IC3 West, that data centre in August, they announced that they were going to increase capacity into it. I think it's 41 megawatts or 42 megawatts.
They plan on 45, but exactly.
It might be 45.
Further approval.
And they're a 75% margin business. As they increase capacity,
once they get those,
it drops to the bottom line, it drops to shareholders. And so the operating leverage that comes from that increase in capacity is enormous. But of course, stock markets don't like capital intensity. They don't like it when you spend a lot of money and you don't see the revenue for a few years. The market's incredibly impatient with that. And therein lies the opportunity. So I won't skip to valuation just yet, but and then you look at AI, And on top of the fact that these guys, have 42 or 43% of the government departments, housed in their data centers, we think that a lot of growth is going to come from artificial intelligence. And the reason that's the case is because the amount of communications that users and enterprise have with the cloud is exponentially larger through the use of AI. And an example I can give you of that is Microsoft's Copilot. When they launched Copilot, you and I do a lot of writing, right? We're writing away. Yep. So how many times do we communicate with the cloud? We communicate with the cloud when we open a document and when we save it. And if the auto-save is set up, then we're communicating with the cloud there as well. Yep. And every time we use the software, so we're using Microsoft, every time we're using an aspect of Microsoft that's being drawn from the cloud, it's not housed on our computers anymore, it's in a cloud. The exponential increase through AI is really obvious to anyone who will use Copilot. Because what will happen is you'll bang out an email to me on Outlook, for example, and what will happen is Copilot will say, "Hey, Richard, that sounds a bit rude. Do you want to tidy that up and make it a bit friendlier? Here's 5 other ways you could say this, and it still sounds like you because I've gone and checked the way you used to write in some of your friendlier emails." And think about how many times Copilot needs to do that while you're typing in real time. It's not only making suggestions and reading what you're writing, but it's also accessing previous emails that you've written, previous Word documents that you've written to make sure that its suggestions sound like you, and then you click on the one that you want. And it's going to do that across millions and millions of users in real time all the time. Not only that, but it has to back it all up. It has to be saved and backed up as well. And so the data usage that's going to be needed is going to be exponentially larger. Now, I think, and I know that there are really serious heads, really smart people in this space who believe that there's going to be an oversupply and a massive supply because billions and billions of dollars are being invested in data centers. But I still think that the rate of demand will be faster than the rate of supply for obvious reasons, because it takes time to build these things. And so what's going to happen is demand is going to confront relatively limited supply, and that will be an opportunity for price to increase. But even without that price increase, just looking at supply, just demand increases and the supply, the capacity increases that Macquarie has, we think on an NPV basis using about a 9% discount rate, we think, or cost of capital, we think that the shares are worth between $100 and $115 each, currently trading at 75 to 80. We bought them with a 2 handle in front, so we bought them in the 20s, and so for the fund. And it was a day one stock for the Montgomery Small Companies Fund. When the fund began, it was one of the first stocks we bought, or Gary and Don bought, and it's been held for a while, and it's going to be held for a lot longer. We think it'll grow we think the market will eventually realise what you mentioned earlier, which is the reliability of its income, and that's going to then be reflected in the share price. Now, we also have another scenario where we think it's worth $180, and we think down the track, when it's fully tenanted and it's just throwing off rent, that's indexed to inflation, we think there's a pension fund out there somewhere or a super fund. And we also know, talking to investment banks, that they're working for these funds and they're looking for these kinds of assets. And with a 6% discount rate, then they'll be willing to pay $180 a share potentially for these sorts of assets.
Well, they're probably all at the video conference, weren't they, talking to each other about this kind of future wealth. But what about Audinate? I don't know as much about. I've covered it in the past, but why do you like Audinate? That's
okay. So
a bit of an interesting sort of.
Yes, it has. So let's describe what they do.
Yeah.
So the big part of their business is some software that is embedded in, or software and hardware that's embedded into the devices that are used for audio in conferences and concerts and so on. So think about all the cables that run from a command and control center kind of environment when you're running a concert or a conference. you've got HDMI cables, you've got...
you just see a massive blue.
Yeah, there's so many different cables that are used and different classes of cable to connect up different devices. Now, what Audinate do is they simplify that. They simplify that setup and they improve the quality of the delivery. And they do that by transferring all of those cables, removing all of those cables and doing it through the Ethernet. Doing through an Ethernet cable. So for sound, for audio, hence the name Audinate, what they've done is they now dominate the global market. So there are literally thousands of products made by hundreds of manufacturers of audio conferencing and concert technology that have their chips and their software embedded so that you can connect and use their product. They dominate that space. Now, the market in Australia is catching on to that. They are growing at double-digit rates, and they've been doing that for some years and will continue to do that for some years. What they're starting to do now is embed the same technology into the visual side of delivering those concerts and those conferences. And that is an enormous growth opportunity for them. And the market really hasn't priced that in at all. And so we think, in short, that's where their growth opportunity is. And then this is a classic example of a business that Australian investors might not even realise exists in the small cap space, listed in Australia, and is a world-class, highly regarded global business.
What about Megaport? Is that...
So Megaport, okay, so think of...
Story that's underestimated?
Yeah, I think it's had a really mixed share price. If you look at its share price, you'll say, oh, gee, this looks a bit volatile,
Yep.
And I think the market hasn't really understood its role in AI and data centers, particularly with respect to enterprise migration to the cloud.
Yeah.
So enterprise, when we talk about enterprise, we're talking about big businesses, right? And big business is still early in its migration to the cloud. When you and I were first working in the industry, and we worked for broking firms, and broking firms had racks and racks of servers on a floor that we had tech guys maintaining. You might remember. You knew the names of the tech guys, and when our computer crashed, they would run down to the desk and they'd fix it, and then they go back into their where they worked. Their office was on that floor where I don't want to call it a data center, but where the IT center was. And big companies had a natural advantage to small companies because they could afford those technology centers within their business, within their tenancy.
Yeah.
That's all changing.
Well, now legacy for these big companies is, in technology terms, is a bad word.
Exactly.
Legacy is a good word for many reasons, but not in terms of technology.
You want to get rid of all of that, all of those staff. You want to make your processes all a lot more efficient. You'll still have still have some stuff, but not nearly as many as you needed before, because all of that hardware is now managed off-site by a cloud provider, by a data center or a cloud provider. So it might be AWS, the hyperscalers, for example. So
well, the hyperscalers are a big part of the future in terms of the occupancy of these.
Indeed. And
they put everyone else in the shade.
So here's the thing. So enterprise is moving to the cloud. So that's a big story. And I still think enterprise is only a third of the way through that story, right? It's where smartphones were. McKinsey's put out a couple of reports that McKinsey put out a few reports on estimating, where we get to by 2035.
Okay.
In terms of enterprise migration to the cloud. But here's the thing. If you're a large enterprise with offices around the world, in order to have low latency, which means low levels of delay when you're communicating with the cloud, you need to be close to the data center. Yeah, right? Okay. But you're an office in Sydney, and your colleagues are working in Hong Kong, or they're working in New York or somewhere else, and they've got to be close to their data center. But their data center provider or their cloud provider is AWS, and your cloud provider is Salesforce, for example. So AWS doesn't want to talk to Salesforce. So how do you get those data centers or cloud providers to talk to each other. That's Megaport. Megaport is Sweden.
Oh, right.
Megaport makes sure that you can talk to each other, and each of you are talking to different data centers, but make it look as though you're just talking to one.
Right.
Right? And it connects them together with hardware and software. So that's Megaport's story. And they are growing their footprint, and they are growing the quality of customers and the number of customers that they're providing those services for. They're going to continue, we believe, growing at double-digit rates, and their price isn't reflecting the growth. That is almost inevitable in our view.
And like we've talked a lot about digital technology, Roger. Are there other types of technology companies like medical technology?
Well, there are, but we're focused on these.
You're focused on them.
We're focused primarily on these because we believe these have what we call structural tailwinds.
Yeah.
So that makes these companies insensitive to the economy, for example. The other area where we see growth, obviously, is discretionary.
Yeah, that's what I was going to mention.
But we're quite specific about the retailers that we're interested in. We're interested in those businesses, and because we're still buying some, I don't want to name them necessarily, but we're interested in those businesses that have a global growth store rollout story.
Yep.
They're the businesses that we're interested in. We think that those businesses will continue to grow off a relatively low base and therefore are less sensitive to the domestic economy. And they're growing their store foot. You know as well as I do, one of the easiest ways to make money in the Australian stock market is to buy a retailer that's growing its stores from 20 stores to 1,000 stores. You know, that store rollout is a really simple way of making money in small caps in Australia. And we think we've got some of those companies and they're growing their store footprint globally.
We've seen some of them fall out of bed quite spectacularly, like City Chic, and like that. We've seen some kind of element, and we've seen sort of Kogan very volatile.
Yes.
You know, for like they get their inventory wrong. In both cases, they get punished. Do you think that these sort of these global rollout stories, because City Chic was quite a famous global.
You don't want to hold these aren't hold forever.
I still know this their hold forever. I'm just saying, I'm just asking which sort of stocks, like what gives you sort of more confidence that they're not going to.
Okay, so let's take. I'll give you one example. Let's say Lovisa.
Oh, yeah.
Right. What we like about that particular business is, all this talk about interest rates harming consumers doesn't apply to Lovisa. Number one, because it's a low price point. But number two, its audience don't have a mortgage. They're living at home with their parents, and they're employed.
They're right to pay customers.
Employment is a drop in Australia, so we've got low unemployment. So these people are employed. They haven't got a mortgage. They're living at home often, and so when interest rates go up, it doesn't harm them at all. And at the same time, there's a huge store rollout story. The cost of fitting out those stores is very low. The company has shown its ability to roll out these stores at a massive rate of knots.
Yep.
And it's constantly surprising analysts with upgrades. And so, that's an example of a business where it ticks all the boxes. But back to your question about, these companies eventually stop growing.
Well, there's not so much
They grow at a lower rate.
And there's big risks of inventory risks that they get wrong, which was quite.
Well, that comes down to management skill, and we think in Lovisa that they demonstrate a great management skill. But what you need to think about is what's called the S curve.
Yeah.
There's slow growth initially, then there's an acceleration, and then it slows down again. And you want to be buying early in that S curve, but you don't want to be holding it afterwards. Because what tends to happen, of course, is everyone buys into the story, share price runs ahead of itself, and then the growth has stopped coming through at the double-digit rates that the price is reflecting. And so that's when you get a share price reaction on the downside. So there is a period that you want to own these businesses, and we like to think that we're in these businesses at the right time.
And have you looked at Retail Food Group at all? Because that's been,
of course,
quite a famous sort of story. For many different reasons.
Yeah, look, there are a lot of businesses in Australia. I ran a subscription-based business, a number of subscription-based businesses. Subscription-based businesses grow really fast off a low base, but eventually they reach maturity. They reach what I refer to as a glass ceiling. It's really hard to break through. And what then happens is you end up with churn, where your customers your customers, you don't get lots of new customers, you have to replace the customers that stop buying your product. And retailers are exactly like that in Australia. Harvey Norman is a classic example. JB Hi-Fi, to a lesser extent, they're still growing. But, you get this, and you mentioned Kogan earlier. Eventually those sorts of businesses, they've captured everyone they were going to capture in Australia.
Yeah.
There's no new customers for them. Everyone who was going to ever subscribe or buy their product has done. And now it's a matter of churn.
Yeah.
And then what happens is you end up paying Google a lot more money for your AdWords, and so your cost of acquisition goes up, your margin starts to come down, and your growth starts to slow. And that's why you get the negative response in the price. When the margin starts to go down or flatten and your growth starts to slow. And that's when analysts start projecting a fairly dire outcome, which usually is an overreaction, by the way.
Yeah.
And then you get cyclicality in the share price for these mature businesses. So it's a really easy story that repeats itself over and over again.
And in terms of technology, you can't go past batteries. You can't go past, the fundamental driver of where a lot of this technology comes from. Is there any kind of battery element to your portfolio?
There was. So on and off, Gary and Dom have owned lithium miners, and where they do, even now, it's those businesses, and they talked about this at the time. It's businesses that are generating cash from production.
Yep.
And there's a big difference between those businesses and the explorers.
Yeah,
we're not convinced. Well, if you talk to the former CEO of Toyota, right, for example, there's not universal agreement that the entire car fleet of the world is going to go to battery electric vehicle. There'll be a mix of technologies, and so and this is another example that we see in the market a lot. You see new technology emerge.
Yep.
People believe that every participant in that technology is going to be a winner. What they forget is that there is a selection of winners and losers, but they bet that the entire space is going to be a winner, that everyone who who's involved in battery electric vehicles, they're all going to win. And that's not necessarily the case. We saw that with Tesla's share price now, by the way, and this is not a small cap, obviously, but Tesla's share price is off 60% from its all-time highs.
Yeah.
This year it's down 30%. Toyota is up. Toyota's going up.
Yeah.
And there's ultimately a selection of winners and losers. And I think when new technology emerges, investors regularly are blind to that inevitability.
Yep.
And they just bet on anything because everyone's going to win, and that's not true.
So you're somewhat on the sidelines when it comes to kind of where the technology's going in batteries.
Gary and Dom might have a different view to me on this, but we all agree that the idea that the entire global fleet of cars is going to be replaced by battery electric vehicles. We agree that that's probably not the case.
Yeah.
There'll be countries where the technology is not available, and they will stick with ICEs. They'll stick with internal combustion engines. Toyota has said that Toyota's view is, or the former CEO's view is, that only about a third of the global car fleet will be battery electric vehicles, and the rest will be hybrid or some other technology.
And hydrogen, for instance, Toyota has certainly made the biggest sort of bet of those big car manufacturers on hydrogen. Japan's quite famous for its hydrogen. It's going to be the hydrogen Olympic.
Well, think about series. There's series hybrid vehicles. They Mazda's looking into this technology as well, and so is Honda. And it's the idea that you have a hybrid vehicle where the electric battery drives the car, drives the wheels, but the petrol engine charges the battery. And we've seen General Motors, for example, demonstrate that they can get 1,100 miles out of
1,100 miles.
1,100 miles before you need to charge the batteries a lot. Yeah, before you need to charge the battery or fill the tank.
Yeah.
And it's a petrol engine that's charging the battery, and the battery's driving the wheels. So that kind of technology is potentially disruptive. We haven't even landed yet on what I think will be the dominant technology. Elon Musk would have you believe it's battery electric vehicles. We're not convinced.
And lastly, just in terms of, I guess, managing a small cap portfolio, Roger, like, what advice would you give people? Like, how many stocks, like how much cash, kind of, is there any advice that you give people in relation to, I guess, the mechanics of trying to...
Well, what we do now in the small cap fund, what Gary and Dom are wedded to, is the idea that stocks have to be, you can't categorize them all as one, small caps. One of the stable compounders, there are the tactical opportunities, there are the cyclical businesses. In resources, for example, we're really positive about this underinvestment in supply in legacy technology, and legacy power opportunities, legacy energy. So we know that there's underinvestment, and consequently prices will respond positively to that. So there are tactical opportunities, there are thematic opportunities, there's stable compounders, there's lots of different characteristics within small caps. That's the beautiful thing about small caps compared to large caps. You can invest in a lot more sectors, you can invest in a lot more growth opportunities, and have exposure to a lot more industries than you can in large caps.
Should people bother about large caps at all then? Or you just really focus on small caps? Like, I myself prefer a combination.
And look, I think
nothing beats a good monopoly.
I think every investor, when they build their portfolio, they should think about the way they would build a boat.
Oh, that's good. That's a good...
Yeah, so we've used this analogy in the past. The hull of the boat is your core of your portfolio. That keeps you afloat.
Yeah.
So you have to have some businesses in there that are high quality and inevitably are going to be large cap. And hey, if you pick the right small caps, they're going to be large caps.
Yeah.
Right? That's the great challenge in small caps, of course, because often the successes leave small caps and the duds fall into small caps.
That's right. Get this failure bias.
Yeah, correct. So, and that makes it a real challenge for small cap investors to do well. And I'm pleased to say small cap funds. But I'm pleased to say in Australia, small cap funds, the median small cap fund manager outperforms the benchmark.
Yeah.
Right? So
we're happy for them.
In aggregate, they're doing a good job for their investors. So you're building a hull. But then what you need is an engine to drive it forward and to keep it pointing in the right direction, because anyone who knows boating knows that when the seas are rough, you want to be facing into the wave. If you don't have an engine or a sail, you're not going to be able to face into the wave. And so you need an engine. We think you need it. I'm a stick boat fan. I prefer engine. I prefer power.
You like everything power, Roger. You're very much a power.
Like tonight,
or it's not kind of sailing on the...
No, I do kayak and paddleboard.
Oh,
yeah, so I can hear that. Yeah, so but they're cross. Anyway, so you need an engine, and I think that engine, that power, comes from small caps.
Yeah.
And then on top of the engine, you need a little bit of a turbo as well to occasionally just give it that extra oomph. And that's where your alternatives might come in. A long short fund. You might have private equity, for example. But in the hull, you've got your big caps and your private credit.
And otherwise, it keeps you on a dividend.
That's what keeps you afloat.
Your income.
The income, and I really think private credit has some superior aspects to it. And you're going to hear a lot more about that in the future. That's going to become a core part of people's. It's going to be a core asset class. That'll go in the hull of the boat along with large caps. And then your engine is your small caps, your quality small caps, which we've talked about a lot today. And then your turbo is your alternative, and you allocate in that proportion.
Yeah,
that's I think how you build a great portfolio.
Well, there you go, from one rev head to another. That's been wonderful having you back on Under the Radar Report. It's been too long, so we'll have to come back again sooner rather than later.
Well, why don't we do it later in the year and see how that thesis has turned out in terms of our small caps outperforming?
Well, definitely. We both live and die by the sword. Thanks, Roger. Thanks for coming.
Great to be with you today.
Okay.